I own a company. Well, part of it sounds pretty official, right? What I actually own is a stock. A stock is a share of a company. A company has a shareholders, the people who own the company's stocks. Think about the company you like. Maybe they make your favorite toys or games. What if you could own part of the company? You can, thanks to the stock market. What is a stock market? A stock market is a system that makes it possible for anyone to purchase a share of a big company. In a stock market, pieces of the company are bought and sold all the time. The company does this to get funding. When a company goes public, it means it enters the stock market. Now any person can buy a stock in a company. The company sets an initial price for this stock in a process called an initial public offering or IPO. People start buying up the stocks, making the company publicly owned. A company may also offer bonds. Bonds are a small amount of money to the company for a set period of time. The company eventually pays back the loan with interest or money in addition to the amount initially loaned. The company can now expand thanks to all its new investors. An investor is a person or organization that puts money into the company to help it grow. What do investors get out of the stock market? Investors are hoping to make more money than they put into the market. In simple terms, if an investor put $5, maybe they hope to get $10 back. Investors use a measurement called a return on investment or ROI to judge how much they make from the investment compared to the cost of the investment. But wait, how can you get more money back than you put it? The value of stock is always changing based on many factors. A stock will be more expensive if more people want to buy it than sell it. When many people want to buy a stock, demand is high. When no one wants to sell the stock, supply is low. There aren't enough stocks being sold for all. The buyers who want one, so the price of the stock rises at the higher price. There are the right number of buyers for the numbers of sellers. Let's look at a simple example. What if there are 4 chocolate bars, but 5 people who want a chocolate bar? There aren't enough chocolate bars for all the people. Maybe all 5 people are willing to pay $1 for the chocolate bar. But the chocolate bar seller is smart. They offer to sell the chocolate bar for $2. Only 4 of the people who want a chocolate bar can pay the $2. Now there are exactly the number of buyers at chocolate bars. The same thing happens to stocks. The price is set so that supply equals demand. This is why the price of a stock is always changing. Investors try to buy stocks when the stock's value is low and sell stocks when the value is high. If the value of a stock went up, the difference between the cost at which the stock was bought and the price at which it was sold of the profit. The profit is the amount of the money the investor made. The profit from selling a stock is known as capital gains. But the value of a stock does not always go up. Sometimes the stock becomes less valuable. Less people want to buy it. Or maybe everyone is trying to sell the stock at the same time. If the investors sell this stock at the lower values, they will lose money when investing. In the stock market, you have to be aware that losses are entirely possible. Investors weigh risk versus potential returns. Risk is a possibility that an investment will lose money. Investors risk losing a certain amount because they believe it is more likely that they will make money. If that sounds a bit like a game, you're not wrong. But unlike a game, investing should be taken seriously. This is real money we're dealing with. The still investing can be fun. Stock prices change every day. Investors often check on their stocks to see how much they are worth at the moment. Stock markets, also known as stock exchanges, are found in many countries. Let's take a look at the history of the stock market with a focus on the United States, home to the largest stock markets in the world. Stock exchange history. Let's travel back in time to 1602. Spices are hot commodities in Europe. A new company is created to sell spices and other goods from Asia and Europe. This is the Dutch East India Company. While the Dutch East India was far from perfect, they did create something that had withstood the test of time. The public corporation, the founders of the company proclaimed all the residents of the lands may buy shares in this company. It was a new and incredible idea. In the past, the average person couldn't buy part of a company. Suddenly, investing was open to the public. Fast forward to 1790, the United States is a young nation trying to set up its financial systems. The Philadelphia Stock Exchange is established as the first stock exchange in the country. 2 years later, in 1792, 24 brokers and merchants get together on Wall Street in New York City. Legend had it they met under the bodywood tree, but it's more likely they gathered at local coffee houses and offices. The brokers wanted to create a standard way of trading stocks and bonds. The outcome of the meetings was the Bodywood Agreement, the founding document of the New York Stock Exchange. If you ever hear someone talk about the NYSE, they are referring to the same stock market. That's right, the New York Stock Exchange has been around for 229 years and is now one of the largest stock markets in the world. The NYSE deals with a lot of money, trillions of dollars every year. In fact, how big is $1 trillion? Let's put it in this way. When you look at the number that represents $1,000, it has one followed by 3 zeros at the end of the number. 1 million ends in 6 zeros. 1 billion ends in 9 zeros, and 1 trillion ends in 12 zeros. It's impossible to count to 1 trillion. If you counted $1 per second, it would take you over 31,600 years to reach $1 trillion. The value of all the companies in the New York Stock Exchange was estimated at around $26.2 trillion in 2021. Despite the big bucks, the stock market has not always thrived. In the 1920s, the stock market had been doing really well. Everyone was making money. This was the period known as the Roaring Twenties. But suddenly, on October 29, 1929, everyone started selling their stocks. It was kids on Wall Street. Everyone was in the panic. A record 12 trillion 88,094 650 stocks were traded that day. The value of stocks dropped rapidly as a result. By the end of the day, billions of dollars were lost. Investors couldn't believe it. The day became known as Black Tuesday. It marked the beginning of the Great Depression, a period of U.S. history when many businesses failed. This affected everyone. People struggled to make a living and support their families. Money was tight. Black American families were statistically the hardest hit. Black Americans experienced the highest unemployment rate at this time. They were said to be the last hired, first fired. Fortunately, the stock market and the rest of the economy did eventually recover. Still, the legacy of the Great Depression is a reminder that the stock market can be risky. Despite the possibilities of a crash like this, if we zoom out to look at the entire history of stock exchange in the U.S., there has been a consistent upward trend in the total values of stocks. The stock market grew as the world's population grew. Companies started selling more. New technology helped companies grow quicker and new products were created. All of this led to steady growth in the stock market. In 1971, a new stock exchange was founded in America. The Nasdaq stock market was the world's first electronic stock market. With the invention of the internet, many new companies joined the Nasdaq exchange. It grew to be one of the largest stock markets in the world. The history of stock exchange in the U.S. is one of the ups and downs. But by and large, the stock markets have continued to grow. In the next section, we will take a look at the stock market today. The stock market today. In 2021, Nasdaq celebrated its 50th anniversary. The stock markets were rocky at the start of the COVID-19 pandemic. People were laid off and many companies struggled. However, optimism about vaccines has prompted a rise in stock prices. It's impossible to predict the stock market, but understanding how it works may give you the confidence to invest in the future. Of course, this program is about understanding the stock market, not about offering financial advice. Still, you might be interested in how people today make money in the stock market. You already know that investors make money when they sell a stock for more than they bought it. But there is another way. Stock can earn the investor money. When a company makes a lot of money in a year, they may give some of that money to their shareholders. This is called a dividend. Dividends are like rewards to investors for putting their money into a company. Dividends can be cash or more stock. Young companies might not pay dividends because they need all their profit to expand the company. Stock represents the strength of a company. How good are its business practices? Does it have a cool new product that everyone wants? At the same time, stock values also rise and fall with the market as a whole. When the whole economy is doing well, it is likely that most stocks will rise in value. If someone tells you it's a bull market, don't worry. No animals are being sold on the stock market. A bull market is a market that is rising. Stocks are becoming more valuable and the market is doing well. A bear market, on the other hand, is not so good. A bear market can be grisly and pounds aside. Bear markets happen when most stocks are declining in value. Bull and bear markets are ways of describing overall trends in the stock market. This trend could last a few months or even years. You want to know how the market is doing? One important measure is called the Dow Jones Industrial Average, or the Dow for short. You may hear a newscaster referencing the Dow when talking about the stock market. Today, the Dow tracks the 30 most influential companies in the market. You probably heard of some of these companies. We're talking about Apple, Disney, American Express, Coca-Cola, Nike, and more. That's right, you can own part of Disney. The way, next time you go to the Disneyland, you can ride feeling like a VIP. After all, as a shareholder, you would own a very small part of the company. Another side of how the market is doing is the S&P 500 index, which tracks 500 of the top US companies. Many of these companies are in the technology and finance industries, and these companies grow fast. Sometimes an investor looks outside, buying a share in what becomes a very successful company. For example, in 1997, Amazon entered the market at a price of $18 per share. Today, one share of Amazon stock is worth around $3,400. Owning stock can be exciting. You are making an investment that may help you in the future. In the next section, we will learn how investors get started. Investing in the stock market one-on-one. Everyone has their own approach to managing their money. Some people have saving accounts. Some people manage credit cards, while others prefer debit cards. Everyone's choices about their money are their own. Many people talk to financial planners to figure out the best way to manage their money. Whether you decide to invest someday or not, it can be useful to know how people start investing. Investing in the stock market is one strategy of wealth building. They're growing of the amount of money as person possesses. Well, money isn't everything and is certainly not the key to happiness. Building wealth can help people accomplish their goals. The stock market can help an investor grow their money without a lot of energy or attention. The investor can have a separate career and spend their time in other ways. All the while, their investment will likely be growing in value. This is particularly true of long-term investments. Remember, the stock market has overall always been on the rise. So if you invest today, your initial investment will probably be worth a lot more in a few decades. As they say, your money is making money. While the stock market can go up and down, generally long-term stock investments are good wealth building strategy. It's important not to put all your eggs in one basket while investing. That means an investor shouldn't put all their money into just one or two companies. Instead, a great investing strategy is to put a little bit of money into a lot of different companies. That way, if one company does badly, the investor would lose too much. And as the whole market steadily grows, the investor will also steadily make a profit. Don't want to take time investing to a little bit in hundreds of different companies. There's a shortcut for that. An exchange, trade fund, or an ETF can be both a stock exchange. Unlike an individual shares by the company, an ETF markets a whole section of the market. Think of the ETF like a basket. Inside the basket, there's a bunch of different stocks and bonds. You can buy the full basket instead of taking the time to select. Everything is individuals. Some companies also put together their own special basket of stocks. They are called mutual funds. A mutual fund is managed by the company to take the burden of the individual investor. After all, it can be time consuming to keep track of hundreds of different stocks. So the company that manages the mutual fund that is not for you. The company may sell off some stocks in a basket to make a profit for the investor, or the fund company may buy the piece of a hot new stock. Remember, other just different. The S&P 500, the STOXX 500 are the best company on the stock market. An index fund allows an investor to buy a little bit of each of these companies. Sounds like a pretty good deal, right? Especially if the investor does not have enough money to buy whole share of each of these companies individually. Because while investing may seem like something for people with a lot of money, anyone can invest. You don't have to be the king of Wall Street to invest in the stock market. You can start small. There are advice that allow investors to put in very little money to begin. That way, the investor can get used to how the market works before investing more money. For beginning investors, it's helpful to find a survey that one track field for investing. Remember, do your own research and come to your own decisions about whether to invest or not, especially as you grow up and start saving money of your own. For now, learning about the stock market is useful to understanding more about how our economy works. That way you have the power to make the right choices for you. Thinking question. Think of 3 companies whose products you like. Maybe they make food, toys, or movies. Look up the company. Are they part of the stock market? How much you want share in the company worth today? In this amount, more or less than it was worth 1 year ago?